In this week's episode of the Stockscores Market Minutes, I'm going to look at the recent correction, try to give you some insight in where the market goes next. All right, hi and welcome to the Stockscores Market Minutes. I'm Stockscores founder Tyler Ballhorn, and today we're going to look at the stock market correction, then do my regular weekly market analysis, and finally look at the trade of the week, just simply trading the S&P 500 with all of the volatility that we've seen lately. All right, before we get into this week's topic, let's first let you know that there are a number of free webinars coming up next week. You can register for them on the Stockscores website. Simply go to Trader Training at Stockscores.com and select upcoming events and follow the steps to register. All right, let's get into this week's topic. The correction. It's been a tumultuous week in the market and many are wondering what's next. If you watched my video earlier in the week on the correction, you will know that this first chart was one of the critical ones that I was looking at. It is the short-term chart, 30-day, 60-minute, and it shows really the corrective action over the last few weeks and the important trend lines to watch. If these trend lines can be broken, these downward trend lines, then we can perhaps see some upward action again. Trends are getting a little parabolic to the downside. You can see that we're curving and running away from that linear trend line, and that's usually a sign that the market is about to make a comeback or bounce back. Until we can break these trend lines, I wouldn't get too bullish, but I would look at trading the market by buying it when it gets really oversold and far below the trend line, and then perhaps selling when it gets up to the trend line. At some point, we will break the downward trend line. Perhaps it will be Monday, perhaps it'll be 2 weeks from now. It's difficult to know, but when these trend lines are broken, at that point, we should initiate the bounce back. And so that's the thing to watch for on the short-term time frame. Now, the longer-term time frame gives us a little bit of a clue as to why the market should bounce. This is the very long-term weekly chart going back to 1993. You can see that this week the market broke that steeper upward trend line that goes back to 2016, and that's actually a pretty negative sign for the market going out the next few months, because it implies that the market is likely to go sideways at best and perhaps even pull back to that longer term upward trend line there. So you want to keep an eye on that. I think short term we probably bounce back, but wouldn't surprise me if we see more weakness in the months ahead as we move down toward that longer term trend line. Now, it's not a decisive break this month because we're just barely below it, and we should also keep in mind that the month isn't over. We have a few more days to make a little bit of a comeback and hold above that long-term upward trend line. So that's what to watch for next week. All right, let's get into the regular market analysis, and I'm going to return to the S&P 500 charts more as just a sense of where this correction comes from. This first chart is the daily chart, and you can see that we broke the upward trend line about 2 weeks ago, 2.5 weeks ago, after a very much steeper upward trend line was broken, and those were the cues that the market was likely going to see more weakness. As I said, we are now at that long-term upward trend line on the monthly chart, and that's why we're seeing some indecisiveness among the bulls and bears as the bulls try to defend the trend and the bears are trying to push it down through, and there's a real battle going on. On Friday, the market closed very near its open with a lot of volatility intraday, and that shows the uncertainty as that battle goes on at that upward trend line. Now, moving along to the longer term chart, the weekly chart, not as long as the monthly, you can see that strong breakdown below the weekly trend line, and that is an indication that the market probably isn't going to move back to new highs anytime soon. And so I think the era of sitting on index ETFs and letting them run higher is probably running out of steam, and you may want to think about, not necessarily next week, but starting to move out of some of those index ETFs on strength. If the market can show some strength, start to unwind those positions and go back to being more of a stock picker, because I think that's where the market is going near term. Moving along to the Russell 2000, and again, this is the daily chart, and you can just see that really sharp downward move. We are now at support, and I've drawn that a little crooked, but you get the idea. And that's another indication that the market should bounce. The small caps have retraced back to some pretty important support where they should bounce back near term. Moving along to the Canadian markets, which certainly have lagged the US markets this year, and therefore they don't perhaps see as much weakness or downside because they have a closer move down to support. Here is the short-term chart, and very similar to the S&P 500, it is in a downward trend, and that downward trend has been steepening, going parabolic. We need to see these trend lines get broken before you want to consider being pretty optimistic about the market. But looking at the long-term chart, you see the reason why the market should bounce. We are at some fairly important long-term support levels, and typically when support is touched that goes back that many times over that long of a period, you usually do get a bounce. So I think on Monday we could see a weak open to start the day and then rally back to hold that support and start to make a comeback after the real strong weakness we've had over the past few weeks. Looking at the TSX Venture, it continues to be struggling. This market has struggled for a number of months. The microcap, the speculative space in Canada, really not doing all that well. Individual stocks on this market can do well if they have something really exciting going on, but the market itself is pretty dead. Investors not feeling too optimistic, and so you want to be pretty cautious with this sector of the market. Moving along to currencies now. The US dollar made a breakout through resistance. We've been bumping up against that. It's a little cup and handle pattern, shows up more clearly on the daily chart, but the fact that we broke through that is an indication that the US dollar is probably going to work higher, perhaps next stop that level of resistance, and then finally the highs from late in 2016. It looks likely that we will continue the upward trend after taking a pause for a few months. Canadian dollar, despite the strength in the US dollar, it actually held up fairly well. However, it is still in that bearish pattern where we have falling tops, and until that cycle can be broken, we are building some rising bottoms, and that's encouraging, but we need to start breaking those downward trend lines before I'm going to get too optimistic about the Canadian dollar. It does seem to be stabilizing, but it is still in that bearish trend. Interest rates, an important chart to watch because, of course, one of the concerns for the market is rising interest rates. You can see that the market broke down about 4 weeks ago, and since that time we've been fairly stable, slightly ticking higher. This is called a flag pattern, and when a flag pattern occurs in a downward trend, it's usually a pause before the next leg of the downward trend. And so I wouldn't get too bearish on bonds until we get that breakdown, but it does appear that that is the likely outcome in the weeks ahead. And of course, if we get that breakdown from a flag pattern, which means bond prices falling and of course interest rates are rising, and that'll be a concern for the market. On to commodities. Gold, with all the tumultuousness in the market, has been something of a safe haven, but not in the way that it has been in the longer term past. I don't think investors rush to gold as a safety as they used to. There's so many derivatives nowadays that people can do that with, even inverse ETFs, where you can, benefit from a market pulling back. And so I feel like this is not really a motivated buyback in gold. At least it's a sign of stability, but I'm not yet ready to be bullish on gold in the longer term time frame. Moving along to oil, we are essentially right at the upward trend line. You can see we've been pulling back for the last 3 weeks, but if I draw this trend line cutting across the bottoms, we have held that this week. Yes, during the week we went below it, but the market fought back, the buyers fought back to keep it above the trend line. That is a positive if you are an oil bull. It is also a cause for caution because, of course, we could bounce along the upward trend line for a week or two and then ultimately break down through it, and if that happens, you want to take a bearish outlook for oil. So my rating's then neutral on the US stock market simply because it is oversold and at some support. I think it probably bounces near term. I think you still have to be cautious because the short-term outlook is bearish, but it is bearish and very oversold, and so I think a bounce should come this coming week. On the Canadian market, same situation, neutral longer term because we are at support where it should bounce, bearish in the short term because we don't yet see a sign of the bounce. Gold, neutral long-term, bullish short-term. Oil, bullish long-term, right at that upward trend line, so we have to remain a bull, but some caution is warranted because we could break the upward trend line, and that is why I have a neutral rating in the short term. Stocks continue to see abnormal volatility, but with emotional selling taking markets down to support levels, a short-term bounce is likely. The longer-term outlook is less positive as damage has been done to the charts and the confidence of investors. Oil is holding its upward trend. Gold really lacking enthusiasm, but it is trying. Fear is high, and that is perhaps too high, a sign that emotion should come out of the market next week. All right, let's get into my trade of the week. And this is a unique chart because I don't normally trade the market itself. It doesn't usually have enough volatility to do so, but of course we've had tremendous volatility this past couple of weeks. And one of the things you can do is simply trade trendline breaks on the S&P 500. Now, if you wanted to get some leverage out of it, you can either do it with options or with some of the triple leveraged ETFs. SSO and SDS are triple leveraged on the S&P 500. And very simple, look for markets when they run away from the trend line. Think about being a buyer, being a seller at the top of the trend line, and then taking a longer term buy view when they break trend. So there we have a downward trend broken there, started a nice upward trend that lasted for a number of hours on Friday. Finally, the trend broken there. Time to exit that position and go short for the collapse into the close. And then, of course, at the end of the day, we had a little bit of a signal to cover that short. Just moving in and out of the market like that can be quite lucrative only because the market's volatility right now is extremely abnormal. And it reminds me of 2008, 2009, a little bit of 2007 as well, when we just had extreme market volatility and some of the easiest money was made trading the indexes through some of those leveraged ETFs and inverse ETFs. Well, that has been the Stockscores Market Minutes for, October 29th, 2018. A reminder to subscribe to the channel, check out those upcoming events, like this video if you indeed liked it, and most importantly, trade well.